given the fact that in the last, say, 6 or 8 months, we have seen such a huge number of financial inclusion accounts getting opened. In fact, I think the system as a whole has opened about 18 crores account. We believe that 99% of the households have been touched, though not fully covered. And that even today, the system is opening around 200,000 accounts per day, of which SBI alone opens 60,000 accounts per day. So given the fact that this financial inclusion has happened so rapidly in the last 8 months, is this the right time for these banks, or are they delayed, or are they ahead of time?
One of those banks is you, so we can take that away if you want. But look, first I wouldn't say there are 13 new banks. I'd say there are 2 new banks and 11 payment banks. And I want to make that distinction clear, because I don't think those 11 banks are a competitive threat to the existing banking system. Instead, I see them as an add-on. In the same way as your relationship with Reliance, I think the other banks will also benefit from this relationship rather than be competed out. So let me start first by saying that yesterday's development, I think the board took the view that it was hard to forecast what would happen in the space. But the payment space was perhaps one of the most exciting from the country's perspective, both in terms of the use of technology, but also in terms of finally reaching, traversing that last mile in a very effective way. And given that we didn't know what could succeed, the board took the view that let's license a variety of players. Some tech companies, some finance companies, some bank mobile combines, a BC, and see how it develops. And I think this is actually a different view of regulation than in the past. Of course, there were concerns expressed about safety and stability, about the impact on the existing banking system. But I think after a long deliberation, the board concluded that these new banks would be additional. They would not compete as much as complement the existing system by traversing that last mile. And the reason for that is these banks actually can't do anything that the, or let me put it this way, the universal banks can do anything these payment banks can do. And the payment banks can't do some of the things the universal banks can do. So in that sense, the payment banks are really useful only because they bring new players into the system who have existing businesses that can reduce the cost of access. And therefore, the payment banks will serve as feeders into the universal banks. If you want a long-term deposit, for example, you put your money in a payment bank which has an alliance with the universal bank, and it gets shifted into a associated account with the universal bank links to the payment bank account. So I see lots of possibilities here. I don't see as much a threat to the banking system. Now, in terms of migration, next month we hope to announce the small finance bank licenses. There will probably be a migration path from small finance banks to universal banks. I don't see that path as easily from payment banks to universal banks. And when we're talking about migration, we're talking about a long time proving yourself in that area before the migration takes place. And then the last question was the new accounts. This is where I hope the payment banks will provide the access to the enormous number of new accounts created by PMJDY. Again, we should find ways to collaborate, to complement, and I think that will be really the benefit from these banks.
Now, today the base rate is at 9.7. And I'm told that the real estate stock is around 4 years. Now, I was just thinking, is it possible that for a little while, something of this kind be allowed? Given the fact, sir, that this is one of the portfolios where the NPA is lowest. Even today, our portfolio, which is 30 lakhs and above, the NPA is only 0.29%. So there's been no bubble built up over here. And maybe we could also ask the reality players to bring down their rates also equally. Means there is already a record as to at what rates they've been selling. So something of that sort means, I don't know, if this is something that could be used as a kicker for getting the retail demand started.
I think there is something to be said for the fact that with the slow pace of transmission, that some front loading by the banks themselves may be useful. But I need to explore the thinking behind the earlier views on this and what kind of safeguards, if one decides to go ahead, would have to be put in. I do also believe that if real estate developers who are sitting on unsold stock started bringing down prices, that would be a very big help to the sector, because once there's a sense that the prices have stabilized, more people would be willing to buy.
Absolutely.
Now, I don't know what the level is, and it differs across the country, and it's not clear that in some parts of the country there's excess stock. But I think we need the sector to, in a sense, the market to clear.
Very true.
And with growing unsold stock, we need to figure out ways to do it. Some of it may be by making loans easier, but we also don't want to create a situation where prices stay high without at a level which means that demand may not pick up to the extent that is necessary. So we need to explore all these issues. But I think we are very open to suggestion. I will echo your view that we do believe that there is pickup, and hopefully if the monsoon doesn't deteriorate and in fact improves, sowing has been very good. You may see rural demand coming back more strongly, and that would be, I think, a very tremendous bonus to the economy. Relative to where we are. So we are all praying to the weather gods to see how they play out.
In fact, the Minister of State in the initial thing said that there is a third FM in the country, and that's the monsoon. So he did mention that. So to just move off from this subject into something else that has been worrying all of us, and if to look at China. So again, in China, we are finding that, first of all, it's impacting us in two ways. On the one side, we have the dumping issues. On the other side, certain primary items, for instance, yarn, iron ore, the exporters are suffering because the offtake from China is lower. And third, of course, is the fear of the currency wars. Now, we have also seen that the Chinese government and the central bank have been very actively engaged in trying to boost the economy. So what are your views on that? Are there any lessons for us, or what should we do in order to ensure that we are able to take on this onslaught?
Well, I have to be very careful about commenting on another country in public. But I think if more generally across the globe, because of weak demand, we've seen significant efforts to depreciate one's currency. You can call it monetary policy, you can call it direct exchange rate intervention. The net effect is that many of the policy actions taken over the last few years seem to have their primary effect through the exchange rate. And that's a worrisome trend. That's a worrisome trend across the globe, because there's only so much global demand. We're all trying to capture it by depreciating our currency. Then it becomes a free-for-all. And we've seen sort of examples of that. The Chinese move, I think, raises some questions about the true strength of the Chinese economy also. And of course, they moved on multiple fronts, including trying to support the stock market, now the currency, and then an infusion of tremendous amounts of liquidity. So it does ripple across the global economy. You have seen in the last few days a number of currencies have depreciated in tandem. We, of course, have been more stable than the others, but we have also depreciated some. I think if the Chinese depreciation holds to about this level, it's not something that one should be overly concerned about. If it is the beginning of a more longer-term depreciation, and I want to say that certainly the central bank's actions don't suggest that so far, but if it's part of the process of gaining competitive advantage through, again, longer-term depreciation, it has to be worrisome across the world. Partly because even the, you could have tit-for-tat actions. We have seen the consequences of a stronger currency in some of our exporting industries. In fact, one of the reasons we see some of the industries, areas like cement, where you think that, we're a growing country, we have a lot of construction, why is cement offtake relatively tepid? And if you look at the data, it suggests that the difference may be in exports, that our exports used to be stronger earlier, now they're weaker. And as a result, cement is not doing as well as one might think, given a 7% growth economy. So these would all suggest that we have to watch the export front, but I think at this point, it would be premature to panic. I want to talk about two issues, one on your side and one on our side. On your side, the question is, put all these aside, there is also a component of poor project evaluation and poor project structuring. Do we have adequate evaluation capability, structuring capability in India? If yes, how do we make sure it's well distributed? If no, how do we generate more of it? That's question to you. And then question from my side, which we worry about, is one of our major efforts has been to try and get banks to recognize distress and to deal with it. So NPAs largely are an accounting issue, but beyond the accounting issue, there's the real issue, the project under distress. How do we make sure that it's put back on track? Which is why we keep emphasizing the fact that it's an NPA doesn't mean you can't lend to it if it needs additional loans to actually complete. But how do we go about ensuring that we take action in all these areas? I know you're committed to it, but across the board, what are the impediments? You've raised some with us, but what more needs to be done to make sure that projects are put back on track, that we give you the flexibility to do that? At the same time, there's enough discipline to not evergreen these projects.
Sir, of course, one of my abiding ambitions in life is to have one conversation with the regulators and with the media where NPA is not mentioned. I don't know whether I'll be able to do that before I leave. But anyway, that's one of my ambitions. So, sir, regarding the NPA, let me start with what you said at the end. That is, why is it that this is an accounting issue and banks are so resistant? So it's like this. The moment you declare an account NPA, giving further money to it, and very often this is required for stressed assets, becomes almost impossible for two reasons. One, of course, is the fact that you will actually be bloating your NPA book further by giving it more money. And second, if you look at the PSBs and the kind of questioning we have to go through with full 2020 hindsight, is that if it is NPA, why did you give it more money? What is the reason that you've given money? You can say that the regulators allowed it, that it was required in order to revive, but the questioning would be very difficult to manage. And as a result, most banks don't have any incentives, once it is treated as an NPA, to do anything about it.
I accept the second thing. The first, we have a little wiggle room there in the sense that new loans aren't immediately an NPA, even though the underlying project is an NPA, until the new loans stop being paid, in which case they become an NPA. So if they have some super priority and get serviced, they could be a continuing loan and be perfectly all right. We don't treat those loans as NPAs.
So, but that is mainly for a project, but you consider a small, say, small trader. And frankly, this is something that I wanted to point out also, that what we have been seeing in the recent past, and one of the things which gives me hope about the recovery, is that we are beginning to see the mid-corporate stress going down. And in fact, even the large of the SMEs, they are beginning to show less stress. The area which is not showing less stress as yet, and this is the area that also gets impacted first when a downturn comes, is the limits below 10 crores. And actually, their time has not come. Now, these limits may need small amounts of infusion, small amounts of debts. Now, I don't really know whether we could classify that as something which I'll retain as standard and the rest goes as NPA. The problem remains that once you call it an NPA, it's dead. So, sometimes my people ask me that why are we trying so hard? And I would say, you have to take an instance like, say, Ebola. We know Ebola has a very high mortality, say 40% plus. But that doesn't mean a person gets Ebola, we don't try to resuscitate that person. And frankly, if you look at organizations, if you look at companies, they are synthetic organizations, they will get sick. So we will need at some point of time to help them get back on their feet. And therefore, this question of evergreening, I believe the evergreening term comes from a lack of trust. And if there is a lack of trust, we need to build trust. We need to build trust that what we are doing is the right thing to be done. And therefore, if you have an independent committee looking in, which is what happens in CDR and also now in JLF, this independent evaluation committee is actually supposed to go in and see that, yes, this particular unit has a good enough chance to survive. And that is when we try and help it, keep it standard, but still help it with more money. Actually, that is what I was trying to say, that you have to incentivize the banks to take action, which you have tried to do. Through the JLF, you have tried to do that. And we are very appreciative of that. And then, obviously, if there are any discrepancies that are coming in, we need to take immediate action. In fact, the media often asks me, when are your moratoriums ending? I keep telling them that the slipping of the account has nothing to do with the moratorium. And it is a fact, as can be seen from our books also. If an account is not progressing as per the CDR plan, whether the moratorium is over or not, they slip. So it's not a bulky slippage that happens. The slippage happens over a period of time, depending on how that particular account is actually progressing. So I think, what needs to be done, if you ask me that, I think in India, and I had told this to you, that whereas in the developed world, it is a slash and burn technique, identify everything, take it all off your books and go ahead with life. In India, because we are such a resource-starved country, and the kind of infrastructure and core sector we have is far less than what we really need. So in India, I say my strategy is pull chestnuts out of the fire. So one by one, you need to retrieve them. And for that, you need a lot of collaboration.
No, I think you've been doing a stellar job in trying to pull the chestnuts out. So your turn to...
Yes, sir. Sir, one thing that we really wanted to understand, and this is from the banking sector, we have found that, sir, there are two areas where the regulators are far more strict than even the international regulators. If you've seen the risk weights that have been assigned, they are much more severe than Basel risk weights. Also, if you look at the LCR, given the fact that we already have so much of preemptions, the liquidity coverage ratio literally is making us keep government paper to the extent of almost, for our bank, almost 28%. Now, if that is really the case, then where is the extra liquidity to lend when the entire credit growth comes back? And as you know, on account of CRR, SLR, LCR, and priority sector, there is hardly 40 rupees out of 100 that we can sort of lend, for commercial purposes. The second thing why this payments bank is a little worrying is because they'll be allowed to have savings banks. Now, what happens if they go in for poaching rates on savings banks? Then many of the commercial banks will lose a portion of the deposit which was relatively lower priced. So that will take away their ability to also, transmit further or give loans at lower rates. So these are the things that are worrying the banking sector. Maybe if you could tell us a little how you see these.
On the liquidity ratios, we have given some flexibility there in using SLR. I will explore this point you made that 28% is preempted for liquidity coverage. I didn't think it was that high, but we'll certainly be happy to take a look at it. The idea behind the payment bank is that if it does access these remote areas and is able to pick up deposits from there, it will allow us to cut the preemption that is imposed on the regular banks. So you will benefit, even if indirectly, from some of the other preemptions coming down, because the payment banks are now required to keep their money in government securities. Now, again and again, the long run has to be that we bring these preemptions down to the minimum. But we can't do it overnight. As you can see, SLR has been coming down steadily, but we also need buyers for government securities to emerge, to pick up the slack as banks come down. Now, so far, it hasn't been binding for banks. They've been above the SLR limit. Now, whether some other limit is binding, which is why they're there, is something we can explore. But I think over time, you will find that there's some benefit when they take deposits because they alleviate your need to take. I do think that the universal banks have to provide a service which is full service. And that's the way they will retain the customer going forward. The lazy customer is probably going to walk to the nearest bank and put his money in savings deposits or wherever. That may be harder to access. But the customer who wants a variety of options, I think you'll have the ability to do that. I have no doubt that banking is going to become more competitive, but I think it'll become more interesting also. And certainly for the customer in India, it'll become much, much more rewarding than today, even despite all the exciting, innovating things happening today. So let us see.
Regarding the risk weights?
The risk weights, I'm sure you'll send me a letter, and then we'll sit on it and think about what we can do.
Right. Thank you so much, sir.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.